Stocks rallying again today with tech as a big winner. The Nasdaq surging almost 2%, but the market's biggest bear is telling clients to double down on getting defensive. Mike Wilson is Morgan Stanley's chief U.S. equity strategist and CIO. Mike, always great to see you.
Thanks for having me.
You say the recent bounce we've seen, that was technical. You could have called it, and you called it. But that's over. Why is that over?
Well, you know, I mean, we think it's over. We don't know for sure, obviously. But, I mean, it does have all the hallmarks of what I would call a bear market rally. We expected a bear market rally at the time, you know, that things got oversold. It probably went a little further, quite frankly, than we would have thought, particularly in the S&P 500. But the Nasdaq's right into resistance again here, kind of throwing back into the 200-day moving average. So from a purely technical standpoint, that's what it looks like to me. So that's how we're calling it. But more importantly, Melissa, I would say the reason we think, you know, it's a good time to remain defensive is because, look, we're late cycle. We've written a lot about this. We think we're later cycle than perhaps some people think, although everybody's talking about an inverted yield curve. We don't think there's a recession this year, but maybe next year there could be one. And so the markets are going to trade defensively. So you can still make money in this market, but what it really means is you got to pay up for earning stability, you know, achievability, you know, operational efficiency, kind of these boring metrics that tend to work at this stage of the economic expansion.
Hey, Mike, is that mega cap tech, in your opinion, you know, when you think about the monopolies, the recurring revenue that all of them are increasingly have, the you know, just the moats and the balance sheets. And so that's the one thing. It's funny. I struggle with it. You hear me. You and I have talked about it on this show before. Sometimes I feel like they're defensive because we know those top four names make up a little more than 20% of the S&P and nearly 40% of the Nasdaq 100. And if they don't give it up, then the markets are not going anywhere.
That's exactly right. I mean, some of those stocks for sure are defensively oriented and they're very high quality, terrific balance sheets, cash flow generators. But even within that group, Dan, you know, I mean, we've seen some separation of the, you know, truly defensively oriented ones and the ones that maybe were pretenders. And, you know, I think it remains to be seen. I mean, you've been around the tech block a long time. You know, you and I have talked for 30 years almost, seems like. But you know, my guess is that many of these stocks are going to prove to be more cyclical than what people anticipate this year. Because of the nature of the COVID, you know, recession, the work from home, the pull forward in demand that we saw in a lot of these tech wares may prove to be a bit more cyclical this year. So that's the risk. That's why we're not as bullish on tech as some others. We're neutral on the group. But we think that the defensive qualities that we seek can be better found in areas like healthcare, maybe even utilities and staples and REITs.
Is there one thing, one factor, Mike, that you could see as being a reason to revisit your thinking on how much further we go down? I mean, would it be a resolution of Ukraine-Russia, for instance? Or, I mean, what would that be?
Well, I think it could be a lot of different things. I think it's the right question. I mean, one of it would be the Fed deciding they don't have to go as fast or as hard, but that's probably off the table given, you know, the inflation that's out there. But that would be a real elixir that would allow the markets to probably go a little bit further. The other thing would be that, you know, we end up being wrong about the earnings revisions, right? So far, earnings have been very resilient at the S&P level. We've seen some deterioration below the S&P level at the stock level. And if we're going to be wrong, it's going to be on earnings. It's not going to be because financial conditions loosen up again. It's going to be because earnings disappoint or don't disappoint as we're expecting as we go through the year.
Mike, good to see you. Thank you.
Thanks for having me.